the debt trap is sprung. And I think this is part and parcel of why prescient central banks have been accumulating gold.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for September 9th through September 16th, 2024, while supplies last. First, we have a very limited supply of backdated silver Australian Kookaburra 10-ounce coins at just $3.10 over spot per ounce. Next, 1-ounce backdated platinum maple leaves are just $80 over spot. And finally, we have compelling pricing on various pre-33 American gold coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this distinguished returning guest. Alasdair Macleod is a former bank director. He's also the head of research at goldmoney.com, and he has his own Substack. He's going to tell us more about that and how you can follow him later on. But Alasdair, thank you for joining us this Friday, September 13th, 2024.
My pleasure, DK.
We were so glad to get this access with you sooner than we usually do because we're both going to be less available for the next few weeks. So we wanted to make sure and get an update from you for our audience. One of the current news stories I wanted your reflections on is the latest tranche of Bank of America stock sold by the largest investor in the world, Warren Buffett, which he's been doing for about a month and a half to 2 months, and now has totaled about $6.2 billion worth of his stock, which is a significant portion of his holdings of Bank of America, where he remains the largest single shareholder. The CEO of Bank of America said, no idea why Warren Buffett is selling off our stock. You've talked to us for months and years about the fragility of the banking system. Can you give us your latest assessment of the outlook of the banking system and what it means, why ordinary people need to be aware of that as they're planning where to keep their nest egg?
Yeah. I mean, if I was looking at it from Warren Buffett's point of view, I'd be looking at the prospects for inflation and therefore interest rates. Now, we know that the headlines are full of interest rates are due to fall by 0.5% or 0.25% or whatever. But all this presupposes that the inflation problem is done and dusted, but it's clearly not. Also, if I was Warren Buffett, I'd be looking at international flows of capital and seeing that the foreigners are basically selling down the dollar, which will weaken the dollar. And if you look at what the dollar is doing, you can see that a weaker dollar is going to require higher interest rates to stabilize it. While, a little bit of a drop in the dollar you can tolerate and all the rest of it. And, the Keynesians would probably welcome a little drop in the dollar because it might support the economy. Ha ha. But you can see that there are a number of reasons why an assessment by a really experienced investor such as Warren Buffett might suggest that there's a lot of risk in the banking sector, more risk than the share prices would indicate. So on that basis, I can understand why he would reduce his holdings. The problem with interest rates, as far as the banks are concerned, is that it would reveal a huge, great quantity of bad debts. I mean, you've got all these zombie companies who have borrowed cheap finance when you had rates at the zero bound. And now, of course, they can't afford to refinance their position. It's just, they really are in an appalling position. And it's not just in America, this is all around the world. But the problem really is enormous for the banks because there are going to be huge, great problems. The banks presumably will require some sort of rescue if this really does deteriorate. And on that basis, do you really want to have all your eggs invested in a bank? I don't think you do. So I can understand why he's perhaps. It could be the reason that he's loosening up on his Bank of America holdings. I mean, I would certainly be reducing my position.
For ordinary moms and pops that have lifelong kept major deposits and savings and certificates of deposit, et cetera, in the banking system as a place of safe haven, going to cash being supposedly the thing you do in times of potential turmoil. What's your outlook, especially now since we're heading into a contentious election season? It's a seasonally difficult quarter for the markets, etc. As far as people seeking refuge from volatility, are the banks a safe haven anymore?
Well, the one thing I would say is that the idea that the Fed and the US Treasury would allow banks to go bust, and particularly major banks, is extremely unlikely. They will replace contracting bank credit by expanding government credit. So what happens is that your deposit in the bank may well be guaranteed, and I'm not talking about, if the bank goes bust, there's, you get bailed out by sort of a massive joint fund. The problem, I think, is that your losses are going to be in the dollar rather than on bank credit being if you like, expiring, being not honoured. So that's the way I'd look at it. Banks will be rescued. I mean, we saw this when we had a number of small regional banks a bit over a year ago. There were no deposits lost. I mean, basically, the whole thing was engineered in such a way that they were taken over. The Fed stopped the run, if you like, on valuations by saying we will permit banks to value, their bonds at sort of full value, whatever they came up with means, if you like, to stabilize the system. They'll continue to do that, but it will be at the expense of the dollar. So that, I think, is really what depositors should be considering. Do they actually want dollars? Do they want deposits in dollars? Do they want credit measured in dollars? And dollars themselves are credit. So this is why I feel that the question they should be looking at more is, shouldn't we get out of credit and get into real money, which, of course, is gold? And this is part of the reason, I think, the fear factor is now driving the gold price higher, which actually is not so much gold going up, but it's more the dollar going down.
That's what I wanted to turn to next, is the outlook for gold. It's hitting all-time highs against most currencies. Especially noteworthy is that it's finally doing that against the dollar, and has been on and off again for the middle part of this year. It's going to be gathering and is gathering more attention from investors who have ignored it for a long time, partly because they've been dissuaded from paying any attention to it by the official financial press, as well as their financial advisors, etc. But your outlook on the fundamentals that are driving the gold supply and demand and availability and cost, if you could give us your update and outlook for that.
Yeah, well, on the supply and demand of physical, we know what's happening. Basically, the central banks are buying and the Asians are buying, and they're clearing out the market. And of particular importance is the Chinese consumer, who has a savings rate of roughly 35% of his income. That is huge. It's around about $6 trillion. The question is, where does that go? It's not going into property. It's not going into stocks. It's going into bank deposits. The rate on bank deposits is being reduced recently, so some of that on the margin is going into gold, and it's going into gold accounts at the banks. And it's the banks that are coming into London and effectively taking any loose bullion they can get their hands on. And so this has created something of a crisis within the paper markets, which we're seeing today. We have had a massive breakout on the upside for the gold price, and the swaps, who are bullion bank trading desks, are caught short. I mean, roughly the contracts on COMEX, you've got around about 530,000 contracts. The swaps are the largest portion on the short side by a long chalk, and consequently they are being squeezed. And I would not be surprised to find that they turn tail and are forced to buy back those contracts in a rising market for gold prices, which could actually accelerate the price of gold very, very rapidly. But other than that, really, the thing that's driving it is principally loss of faith in fiat currencies, and particularly the dollar. If you look at the trade-weighted index for the dollar, that's got what the technical analysts call a death cross, which basically is a very, very bearish sign. We had the death cross a week or two ago, and I think it's rather signaling that the dollar's trade-weighted will fall from around about 101 at the moment, probably through the 100, and then the next stop is around about 90. This is a very major move down. And in very, very uncertain times, normally you would expect funds to flow into dollars, which are seen as safety. They're not. They're flowing out of dollars, not into euros. Well, I mean, there's a little bit on the margin, a bare closing maybe, euros, yen, sterling, and so on and so forth. But it's basically going into gold. And I think it will spread from that into other commodities. We've had weak commodity prices recently. I think they've weakened too much. Silver has really caught a bid. That's been rushing up and has got a long way to go. I mean, looking at the moment, the gold-silver ratio is 84. It was 85.5 this morning. That should fall, I think, towards 70 and below, which tells me that silver is going to be a lot more powerful in its up move than gold. So, but it's being driven by gold. So the whole thing has got a developing air of crisis in the markets, I think. And I would go back to what I was saying about Warren Buffett's position. I mean, if you look at the inflation outlook, interest should not fall. They should actually be rising. But the problem is that the underlying economy, US economy, is not performing well. And I don't know whether you noticed this. I think it was yesterday, the budget deficit for August was released, and that was about $380 billion, about twice the level which it was during the COVID crisis, when there was no income coming into the government and accelerated payments out. I mean, this is a very nasty shock, and it tells me that the US economy has run into a brick wall. And by way of confirmation, we have also had information this week about the Chinese economy, which tells us that has slowed very rapidly. And on the production side, that again has run into a brick wall. Why has it run into a brick wall? Well, I mean, people who hate China say, well, it serves them right and it's the Chinese economy, it's their mismanagement and all the rest of it. But that's not really the case. The case, as far as China is concerned, is their export markets have collapsed. Their major export market is the US. The consumer is not buying. There are problems. So you can see that this sudden crisis, if you like, in government debt in the month of August, which incidentally takes the government borrowing, the interest on debt, to an estimated 1.2 trillion for this year, higher than defense spending, I think. I mean, this is a debt trap. And the last thing that America wants is a stalling economy, because they will not be able to pay their debts. The debt trap is sprung. And I think this is part and parcel of why prescient central banks have been accumulating gold. I mean, we talk about the America's loss of influence and the Asian hegemons and all the rest of it, and how they've been accumulating gold. But I think at the margin, what we have seen is a lot of central banks are actually taking a very, very negative view on the fiat currency system, and they're just looking to protect their own currencies. So this is a time, I think, of crisis, really, DK. And on top of that, we haven't even touched on the developing war between Russia and NATO. I mean, this week has been bad. It really has been bad. And our prime minister at the moment is in Washington, or he will be tomorrow. I think it's today anyway, talking to the US government about upping the availability of cruise missiles and all the rest of it to the Ukrainians, so the Ukrainians can attack Russia from the inside, guided, of course, by NATO personnel, NATO satellite technology and all the rest of it. I mean, this is NATO versus Russia. I mean, let's not mince any words about it. This war is escalating. It depends what Russia does. But I mean, it seems to me that this is an extremely dangerous situation, which could easily escalate into a nuclear confrontation. This is not good.
Well, you've cheered us up with this round table of good news. One more thing before we leave the U.S. economy, which you mentioned quite in a spotlight there, is the recent pronouncement, and you can look at it as an almost perfect contrarian indicator of Janet Yellen saying this week. She does not see any flashing red lights on the dashboard here for the economy, and that's in the face of what they call the supercore CPI running about twice as hot as their nominal target, and also unemployment spiking, and the uninversion of the yield curve. And you'll probably tell us more things, but could you give us a few more salient pointers on the state of the U.S. economy and how in the past, when we've been at this stage of the credit cycle, as you often guide us to look at things from that viewpoint, what usually follows?
I mean, comments from Janet Yellen, in a sense, I'm inclined to give her the benefit of the doubt and say that she has no alternative but to say what she says. So, she may believe something completely different. But, I mean, there are other areas of government, your government and our government, which are completely delusional. So, I think it would be a mistake to give her the credit, if you like, for just simply lying in ignorance, or being ignorant rather than lying. I think, we are in this credit cycle. The credit cycle is the one that drives the business cycle. The banks are beginning to see, they've been seeing risk for some time, but I think that risk is escalating. They have put quite a lot of their balance sheet into very short-term U.S. Treasury debt by buying T-bills in particular, and maturities at up to a year. Where else do they go? They can't really reduce their balance sheets, unfortunately for them. In aggregate, an individual bank can. But for the rest of the banks, they can't really do it. And the problem that the US economy now faces is that basically business has no credit. There's credit still being offered to consumers, and there's some credit which is still outstanding, I think, on investments in the stock market. Now that's, I think, next in line for very sharp reductions. It's not going to be good. But the idea that this suddenly is going to take the pressure off inflation is, that's dreamland stuff. Because production, the point about it is that production is collapsing. And with production collapsing, you get less supply of goods, which happens maybe slightly ahead of less demand from consumers, from strapped consumers. And the other thing which the monetarists actually miss entirely is that the value of the dollar actually depends on the faith and credit in it, more so than the quantity of credit in circulation. On that basis, you can see that foreigners are getting the hell out of the dollar. This is why gold is rising. It's the biggest signal that the dollar, I think, is in the initial stages of a fiat currency credit crisis. Do we have faith in the dollar? I don't think so. And, with the war starting up more aggressively between NATO and Russia, it's definitely going in that direction for whatever reason. Russia is actually in a far better financial position than America, because America's starting point is, we saw the August figures for the deficit. But generally, if you look at the amount of debt to GDP is over 130%. The economy is now, run into a brick wall. That debt to GDP ratio is going to start rising very, very sharply. because of lack of tax revenue, because of any increases in welfare costs and all the rest of it. This is not good. This is not good.
In the face of you mentioned Russia and other nations pivoting away from the US dollar and into real things, commodities and gold in particular. This has been going on now for a number of years, and it seems to be accelerating. In parallel with that, they have been publicly stating that they're working on developing a new trade settlement currency. Can you bring us up to date on your latest analysis of that and how the implications of that for the dollar and for the West?
Yeah, I think that a lot of the commentary on this has been misguided. There is an assumption in certain quarters that there will be a new currency on the agenda at Kazan, which is the October summit for BRICS. I don't think there will be. There may be some mention of it on the basis that an updated planning and so on and so forth. But what people have latched onto is a proposal for a new currency, which was called the unit. Now, this currency was produced, the paper on it was produced jointly by a Russian and a Chinese individual. But when you look into the background of these people, they are actually private sector investment managers. This is not, a joint government, Russian Sino operation at all, which the names you would think suggest it is. No, it's not at all. And furthermore, it is quite clear that the authors of this unit paper really don't understand credit. They don't understand the relationship between money and credit. They have recommended a backing of 40% gold and 60% currencies, which are valued on a day-to-day basis in terms of gold, and the whole thing put on some sort of blockchain. There is this tendency, I think, to overcomplicate really what essentially is a very, very simple relationship. The way a gold standard works is really extremely simple. A currency must be freely exchangeable, either in terms of cash or in terms of bank deposits for gold at the central bank. It's actually as simple as that. And it's easy to put in too. And it's easy. We do know how to manage gold reserves. You do that by using the interest rate to manage the gold reserves. You do not use interest rates to try and manage economic outcomes. That is a huge, great mistake. As we've seen, time and time again, interest rate policy has achieved absolutely nothing. If anything, it's probably made things worse. So it's all about having sufficient gold reserves in the background to give confidence to people that they don't need to cash in their dollars or rubles or whatever it might be for gold. And that is maintained by the issue department actually having control over interest rates. There are various other aspects of this, but they are relatively simple. And I wrote a paper on this for my Substack readers, which came out yesterday. Yes, yesterday. So I think that the whole of this trade settlement currency thing has been blown up unnecessarily. And in fact, it's actually very easy for Russia and China, perhaps, to deal with this. If they were minded to do so, they would say, take 100 tons, and they wouldn't need more than that. Probably even 50 tons would do it, of bullion to back a new trade settlement currency, which you could call anything you like. You can call it the unit if you want. But the point is that the currency is credit and it is anchored to gold. So it have to be readily realizable in gold in order to give it its credibility. It's very, very easy to set something like this up and then say to BRICS or SCO members or whatever, if you want to use it, it is there. If you don't want to use it, that's your choice. It's really as simple as that.
Alasdair, You are on top of so many aspects of this, poised as you are between the East and the West there in your, on your island enclave of the UK. Can you tell people how they can stay in touch with you so that they can follow your continued analysis of these situations as they accelerate?
Yeah, the best way to do it is to subscribe for my Substack, which is alasdairmacleod.substack.com. Google it, you'll find it. I'm glad to say that that's growing really quite rapidly. I have a mission really to keep people informed and educate them about money, credit, economics, and geopolitics, which are now such an important part of the pricing in precious metals markets.
Well, we're always grateful for your presence here with us and all of our viewers and subscribers here on Liberty and Finance. And folks, if you are one of those 50% of our viewers who are not yet subscribers, it's free. All you got to do is just click the subscribe button on YouTube or on Brighteon or Rumble or any of our other platforms, and make sure that you stay with us and follow all of the developments here. If you want to get a free email every time Alasdair is on and our other guests, so you know who's on each night, just go to libertyandfinance.com, put in your email address, click submit, make sure you confirm on the confirming email, and you'll get one email from us each day with our latest interviews, including all of our interviews with Alasdair and all of our other guests as well. Alasdair, on behalf of all of our viewers and subscribers, thank you again for joining us on Liberty and Finance.
That's my pleasure, DK.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for September 9th through September 16th, 2024, while supplies last. First, we have a very limited supply of backdated silver Australian Kookaburra 10-ounce coins at just $3.10 over spot per ounce. Next, 1-ounce backdated platinum maple leaves are just $80 over spot. And finally, we have compelling pricing on various pre-33 American gold coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.